Alrighty. Hello, everybody. Thanks for tuning in. We should be live on multiple platforms right now. If you're watching on our website, thanks for tuning in. We should be live on. All right. Sorry about that. Okay. We're going to give it a couple minutes while everyone's tuning in here. Throughout this whole presentation, and show and everything, please drop your comments in whatever social channel you're watching on. If you have questions for Will or Luis throughout this program, we'll be answering them. We're going to be doing a Q&A kind of the whole time. And we're going to give it a few minutes here while everyone joins. If you're having trouble, the link is joinentre.com/live. We'll give it a couple more minutes here and let people come through. Let me just make sure people have the link right. If you're watching it from our website, there's a chat on the website to ask questions, or if you're watching on YouTube or Facebook or Twitter, you can comment and we'll get your questions that way. In a minute here, I'm going to introduce Will, and we're going to kick things off with a COVID update on all the business loans and everything that has happened over the last week. We did our first event like this last week, and it seemed like everyone had a bunch of questions, and there's always new stuff going on. So we wanted to do another one and just keep you guys updated on everything that's going on with the loans and grants and whatnot. And then Luis is going to dive the finances and everything for you guys as well. Real quick, as we kick things off, if you don't know who I am and what Entre is, we're a social network for entrepreneurs. I can show you guys real quick, basically what we're all about and really how we've built out our network. We do these events really to help you guys just get more information on what's going on. We have a bunch of upcoming events here. Give it a minute as my screen loads. And then let me change the background here. Okay. So you guys should be able to see our calendar here. I'm going to bring on my partner, Jimmy, too.
Hello,
hey, Jimmy, you there?
Hi, welcome.
So we have a lot of upcoming events going on with founders, investors, VCs, angels, and we're really just glad to be able to do these still. Even though they're virtual, it's really just a way for you guys to stay connected to our community and hear from top-level CEOs, investors, founders, all of that. So, Jimmy, you want to give people an update real quick on some of the upcoming events?
Yeah, thank you. Thank you all for coming. The events we have coming up are fantastic. Every Thursday, like Michael mentioned, we're going to be doing a COVID relief opportunities and finance live stream for free to give you updates on what's going on. Next week, April 13th, we have the CEO, Brian Freeman, who's a founder. The 14th, we have the CEO of Popcom, and she's going to be Popcom. She's going to be discussing fundraising and crowdfunding, which is very crucial right now as VCs and angels are pulling back on their funding. And then April 15th, we have a founder from DC, Talia Waller, who's going to be speaking. And then Thursday, we have the COVID-19 relief. And then we have other events coming up. Check us out at joinentre.com/events.
Thanks, Jimmy. Yeah, there's a lot of stuff we're doing with the events, but overall, we're really just trying to be that resource for entrepreneurs right now during these times. If you guys are interested in being part of our community and getting into what we're building with the app and everything else, too, just go to our website, joinentre.com. You can sign up to get first access to the app. We're going to be releasing it actually in the next couple of weeks. We're submitting it to the App Store shortly. So a lot of exciting things are brewing here. Then we have a lot of other things on our website. If you guys are interested in mentoring and getting more help starting your businesses, We're rolling that out. If you want access to all of our events for free, we rolled out an Entre Pro program just to give people more benefits to being part of our community. So with that being said, I'm going to, there we go. Okay. So I'm going to kick things off here with Will to give you guys an update. Jimmy, thanks. He's going to be coming on later to do the interview with Luis, and we'll see Jimmy in a bit.
Thank you.
Thanks, Jimmy. Okay. Let me get Will up here. Hey, Will.
Hey, Mike. How are you?
Doing great. Doing great. How is everything going? Are you all up to date on all things COVID? There's a lot going on.
We're trying. We're trying. You know, since it feels like ages since this time last week when we had the first webinar, and you know, there's a lot of changes, a lot of clarification. I can't even. I know I'm an accountant, but I can't even begin to count the number of questions I've had to answer since the last webinar. You know, we've been trying to help out clients and anyone calling our office so they can get their money. You know, but there's a lot of clarification that's still needed, although there has been some more clarification regarding both the EIDL loan and the triple P loan. I'm going to start calling it the triple P loan. It just sounds better than the PPP loan, and it rolls off the tongue a little easier. So I'm now calling it triple P. You know, just I do want to let everyone know out there that the first round of aid is actually being taken. So the stimulus checks that the IRS was promising, they are being sent out. There are a number of taxpayers that have gotten their stimulus paychecks. I don't want to say paychecks, but they got their stimulus pay in the form of either a paycheck or direct deposit. Now, those individuals, it seems that those individuals are the ones that filed their 2019 returns already. I think the IRS is probably going to wait a while to give stimulus checks to individuals that have not filed their 19 returns because you know, there's a little strategy that goes into you know, whether we should be in a rush to get our 19 returns filed or not. You'd want to talk to your accountant about that to determine what's right for you, if you're listening. One thing I wanted to clarify, so this famous $10,000 that everyone was going to get within 3 days of applying for the EIDL loan, there's talks, there's a fairly newly released guidance out there from the SBA that they're now going to come back on that. And now the rule is you get $1,000 per employee. So for individuals that thought they were going to get the $10,000, it appears that they're not going to get their $10,000 of free money. They are now going to get $1,000 per employee. Now, what does that mean for these self-employed and these independent contractors? Well, I'm going to guess that they are going to get $1,000 if they are self-employed or a sole proprietor and they don't have any employees. They're going to be limited to $1,000. That would obviously still be free money, but it would be $9,000 less than the initial $10,000 they thought they were going to get. I don't know whether that is definite or not, but that is what the SBA is saying at this time. I don't think anybody's gotten that $1,000 yet either. So it will be interesting to see in the next week what comes of that. Another article said that this $1,000 per employee, individuals were going to get the funding this week. Well, we are now here on Thursday, and I have yet to hear from anyone that has gotten any sort of money through the EIDL loan program, whether it be the loan itself or the free money. The advance is what they're calling it. So still be patient. A lot of listeners are probably going to be bummed about that. Just keep in mind, I don't make the rules. I just relay the information. And now, what's interesting, there's been a lot of development since last Thursday on this triple P program for the triple P loan. That's where we've been getting most of the questions. And a lot of the questions have been centered around whether you're a self-employed individual or a sole proprietor. Hey, Will, how do I fill out this darn application? right, that the bank sent me. If I'm self-employed or sole proprietor, they're asking for number of employees, or they're asking for other things I don't have. What should I put? My advice to those individuals has been, and it is to you for those that are listening, I would talk to your bank, because each bank is handling these loans a little differently. Some of them are asking for certain items and some of them aren't. For self-employed individuals and sole proprietors, your bank's going to initially come to you likely and say, hey, listen, we want your payroll returns for the last year. You're going to go to your accountant and say, hey, listen, my bank's asking for payroll returns. What the heck is that? Well, you've likely never had a payroll return if you're self-employed or an independent contractor. So you will not have those items. And there's a big disconnect, because the bankers are asking for this information, although the business owners are clearly telling them, hey, listen, I'm a sole proprietor or self-employed individual. So, there's still a lot of clarification, and there's still a lot of loose ends that need to be tied up. There has been some funding. There's been a fair amount of funding through the PPP loan program. Businesses are getting loans through the PPP program. Not as fast as most businesses thought they would, but they are getting funding. And I'm hearing from a lot of clients too that they are going to the actual SBA and actually getting SBA loans in which they can have payments taken care of by the SBA for 6 months. So for the first 6 months of your new loan, you have the opportunity to get those payments taken care of by the SBA. So that's a good deal. Another clarification with the PPP loan program, they said that up to $100,000 of an individual's pay can be factored into the calculation. That does not include any non-cash payments by the employer. So if you pay someone $100,000 in wages, but you also have an employer match for your retirement, and you also pay part of an employee's health insurance, you add that to the $100,000. So essentially, you can get over $100,000 of pay to an individual included in the PPP calculation. There was also some clarification on, hey, I'm a business, but I contract out to a third party, to a professional employer organization that in turn hires our employees for us. So we just pay one fee, and another entity out there provides us with our employees. Can we still do the PPP program? And I believe the answer is yes, based on the Q&A that the SBA put out recently. So there's individuals out there that thought initially that, hey, maybe it wouldn't apply to us. That still would apply to you. So again, I think you're going to have to go to your banker or your financial institution and ask them, hey, listen, how do I fill this application out? If we pay a professional employer organization, because this application, it's inconsistent with those self-employed individuals and those sole proprietors and those businesses that hire a PEO for their payroll. These applications weren't made for these individuals. They were made for businesses that have employees. So you're going to have to give your bank some clarification there, and maybe have your accountant talk to your banker as well. We're doing that for a few clients as well. So, your CPA should be happy to do that for you. One big thing we wanted to clarify. Last week, there was very little guidance as to whether or not a business can include their independent contractors they pay in the PPP program loan average employee costs. And the answer is actually no. Soon after our webinar last week, the day or two after, they came out with more guidance, and now it's clear. If you're a business and you pay employees as well as or independent contractors for work that they do for your business, those independent contractors are not included in the average payroll costs for determining the PPP loan max. So I just wanted to get that clarification out there because that's very important. So So what determines number of employees? Getting back to the $1,000 per employee for the EIDL program, just to clarify, they are saying number of employees as of January 31st, 2020. And again, that has nothing to do with the PPP program. That's for the EIDL loan itself. So there's been a lot of talks too about lately, articles going out there about an additional $25,000. I don't know what they're going to call it. Another $25,000 of assistance to certain individuals out there on the front lines. These essential workers that are out there closest to COVID-19 infected individuals and potential infected individuals. There's talks that there may be $25,000 of assistance that these individuals can get. I think it's too early to tell whether this will become available or not, but there are talks of giving these individuals an additional $25,000. So it'll be interesting to see what comes of that and how far this will go. I would love to see that happen because it's a scary world out there right now, and these individuals need it more so. I mean, if you think about it, these individuals don't need $25,000. They need to have a vaccine where they're not going to get infected while they're helping these other individuals out. But the $25,000 will go, I guess, a long way to kind of just rewarding these individuals. So keep that in mind. Like I said, that there's nothing to do right now regarding the $25,000. So don't leave here after we're done and say, oh, we're going to file for this $25K because we're essential. And they're saying that medical workers, restaurant owners, and federal employees, they use those individuals as an example of who would qualify for the $25K. So keep trucking along, and the PPP program, the EIDL loan program, is still out there. Tomorrow, the 10th, the PPP program opens up to self-employed individuals and sole proprietors. So that's when the banks will start processing your applications as well. So make sure you're talking to your accountant to make sure you have all your ducks in a row, because each bank asks for things a little differently. And make sure that you have your latest financial information with you. Technically, April 15th, the initial tax due date is next week. So I'm assuming a lot of CPAs are real busy with bookkeeping, but I think a lot of us are willing to kind of put our chargeable work aside, hopefully, and help out these businesses and individuals that need guidance and assistance to get this money. Because right now, a lot of people aren't getting any money at all through their business because they've had to shut down. So we're doing what we can do, in our power to help move the process along a little bit. So take care, everybody, and just please be safe and healthy, and we'll all get through this together. I think now we're gonna back to Mike.
Yeah, we're gonna open it up to Q&A. Whatever platform you guys are watching it on, drop it in the comments. If you're on our website, there's a little chat. You'll see me on there. It comes right to my phone, so I'll be able to answer any questions that you guys have throughout this. But we also, Will's going to be updating his, we have a document that we've been preparing for you guys. So we are going to be sending this out. This is going to have all the links and all the information that you guys need in one place. So if you want this document, drop your email in the comments, or feel free to just email Will or myself so that we can get you this document that has basically a comprehensive database of all the information that you're going to need on this. And it's a Google Doc, so we're going to keep updating it as things go on because, like Will said, there's so much changing every single week with all this stuff. They're constantly rolling out new things. I'm pretty sure I just saw the Federal Reserve just rolled out a new $2.6 trillion approval. I don't know if that's on top of the other 2.1 trillion or if that's an additional. So there's so many things developing, and this is just the beginning. So we want to be here with you guys throughout this whole process, and we want to be here with you guys as things go on so that we can keep doing these every Thursday to keep you updated, to keep updating the document so that you know the newest programs that are out right now, and then any other things that are going on. We have, so if you guys have questions, now's the time for Will. I haven't seen any come in, so you must have done a great job of explaining things, Will. But we'll keep you posted, and then I'm gonna keep an eye on all the questions and stuff as we continue on through here. And if there's anything like that you guys in particular want to know or talk about, please reach out to us and ask now, or feel free to send us an email later as well. But so we do have someone who. Okay, it looks like Alyssa just sent her email for the document, so that's good. Definitely keep doing that, guys. If you have specific questions, feel free to email Will or myself, or drop us a note. And I think I'm gonna bring on Luis and Jimmy now. You guys there?
Hi.
Yeah, I'm here.
Hey, everybody. All right, thanks, Will. I appreciate it. I'm also gonna go off as well, and I'm gonna leave it to Jimmy and Luis to keep things rolling here. Again, if you guys have questions, drop them, and then Luis and Jimmy will get to them at the end, close to around 5 o'clock. So thank you, Will, so much for all of this. He's been great for us, and just keeping on top of all this stuff for businesses, and so definitely reach out to Will. If you guys mention Entra and need help with any of this stuff, you're going to get 20% off like tax and accounting stuff with Will too. So he'll definitely be able to, if he can't help you, he's going to point you in the right direction, but he's been on top of his game with all this stuff, and he's been great for us. So definitely use him as a resource throughout these times, guys. All right. That being said, Jimmy, the floor is yours. Luis, crush it, man. I'm sure you guys are going to get into some very, very interesting content right now talking about finances. So thanks, guys.
Thank you. So I'm Jim Dulambakis. I'm co-founder of Entra. I have Luis Sanchez, who's managing partner of LVS Advisory, who's a financial advisor based in New York City. He works with individuals, families, and business owners to create great strategies, investment strategies, and I'll let him talk a little bit more about it. Luis, how are you?
I'm good. How are you?
Good. So tell us about the company and what you do. Give us the insight.
Yeah. Thanks for having me on, Jimmy. And, I just first want to say that being based in New York City, I have a lot of friends and family who are directly impacted by the current pandemic, and my heart just goes out to everyone who's affected. And I have tremendous faith and belief in the human spirit, and I know that we're going to overcome this, and we're gonna get through this. So yeah, a little bit about what I do. I'm a registered investment advisor based in New York City. I work with individuals, families, and business owners on financial planning and investment services. I guess just as a quick disclaimer, just please keep in mind that this is not intended to serve as financial advice. If you hear something that I say that sounds interesting, I implore you to do your own research and consult with your own financial advisor before taking any action. So I guess one of the things, just to kind of set the stage here, I just wanted to, put some context into, what's going on in the financial markets. And I read this really great article by Jason Zweig a couple weeks ago, which I think really helps set some perspective. So I'm just going to read the first part of this article. And it goes, it's springtime in the year 2030. You're looking back at the crash of 2020, the devastation it dealt to your portfolio, and how you behaved as an investor. What will you say? If human nature is any guide, and let's face it, it is, your accounts of what happened will begin with such words and phrases as clearly, or it was obvious to me that, or everyone knew that, In the future, your memory of the crash of 2020 won't be a recollection. It will be a reconstruction built partly from what is happening now and largely from what you learn later about what hasn't happened yet. So what I think is really great about what Jason wrote there was, as investors, and this is the way that I think about investing, and the way that I always encourage everyone else to think about investing, is it's important to think about the long term, because when you're making an investment today, you're hoping to get a return that you can benefit from in the future. Maybe that's 5 years out, maybe that's 10 years out. And so really the best way to think about how you're investing today is to think about how you're going to look back on this in 2030. And for anyone who's lived through 2008, 2009, or 2000, 2001, just think back to how scary that was and what was going on and how you reacted to it, as a pretty good guide for maybe how you should think about your investment portfolio today and going forward.
Awesome.
And yeah.
So, Luis, that's fantastic. I love the article. It's great. And, I'm based in New York as well. So we've been, very impacted here. It's become such a hot zone for the coronavirus. And Wall Street is in New York, right? So it's all tied together. Now, most individuals today are facing it's hard. If you have your investments, you've seen 30 to 60% reduction. We're in a panic. We don't know what's going to happen. What's some thoughts or strategies, or how should people approach this actually?
Yeah, it's a great question, and it's something that I get asked every day. I have a couple of stats that could actually kind of put this into perspective, and I think that are really interesting. So, right now, I think it's fair to say that we're experiencing the sharpest economic contraction in modern history. It took 23 days for the S&P 500 to fall over 20%, which is a record. There's 16 million unemployment claims that have been filed. And I mean, regardless of what metric you look at, uncertainty as implied by the financial markets has never been higher. So, I mean, everyone wants to know where stock's going to go next. And I mean, the real answer is that I don't have a crystal ball and nobody else does. My only prediction here is that it's going to continue to be volatile, and it's going to continue to be volatile until we have some real clarity on the economic damage, whether or not it's safe to go outside if we have a vaccine. And I mean, at this point right now, so we're recording this on April 9th. At one point in March, the S&P 500 was down 35% from the peak. And as of today, it's actually come back. It's recouped about half of that decline. And I actually have a slide here. I don't know if you could see it if I share my screen. Is the screen being shared? Okay.
Yep.
So this just shows what happened in the last two recessions, which I think is our best guide. And okay, so sorry, this is a little muffled, but if you look back at what happened in either recession, really, there were multiple time periods where the market went up or down 20%, followed by another leg of going up or down 20%. So as I just mentioned, we've had a big leg down, we've had a big leg up. Some people think that because the market's come back up so much already, then that's a sure thing that we're going to go right back to where we were. And the reality is that it isn't. The reality is that the environment's really volatile. And I would just continue to expect these kind of big swings. And, just kind of going back to that statement I made at the beginning, it's not really about trying to predict the next big swing. I think that's a loser's game. It's really about trying to see through the volatility and just try to see where you want to be at the other side of this. So, um,
And those numbers you're showing, so like, for example, the first number was the difference between September 1st and April 4th. It was a decline of negative 27%. Is that how I'm reading it?
that's correct. Yeah, and that would be like the S&P 500.
So, I mean, within the windows here that you're showing and the time frame, I mean, there is some there's a lot of similarities here that are showing us like kind of some repeat of what's happening. And obviously, we can't see now. We'll have to see that in a few years, right? Or in a year from now, we'll be able to look that over. So, should people stay calm? I mean, my investments are down. What am I doing? What can we do here? There's a international panic going on. Markets from all over the world are down, not just the United States.
Yeah, absolutely. So the best way to stay calm is to basically is to have a plan and to know why you have that plan and to execute against that plan. So any financial advisor worth their salt is going to construct a diversified portfolio for their clients, and that portfolio is going to have different types of assets in there that don't all move in the same direction and in the same volatility. So just as an example, so far year to date, if you had invested in what the aggregate bond market, so the Barclays aggregate bond market, which is like the benchmark for US bonds, you'd actually be up 3%. And year to date, after taking into account the up and down, the S&P 500 is down 15%. So there's the most common portfolio that an advisor would recommend would be what's called the 60-40, where it could be like 60% stocks and 60% and 40% bonds. So if you had a 60-40 portfolio, as of today, you would only be down about 8%. So I think, when we have 10 years of a stock market that only goes up, I think people are very exuberant and they're inclined to put all of their money in the stock market. But when you have a volatile year like this, it really shows the benefit of having a diversified portfolio. And now that the volatility has come, had you been positioned such that you weren't all in stocks, you actually may have an opportunity to do what I call like a rebalance, where if your bonds have held their value but your stocks are down 20-30%, if as long as you're long-term oriented and you can kind of wait through the end of this recession and onto the recovery, it probably makes sense actually to think about adding to your stock portfolio, maybe going from a 60-40 to an 80-20, just to kind of take advantage of the relative move. And there's certainly other ways that you can think about rebalancing.
So what type of so if we do 80-20, what type of industries are we looking at? Like, are you saying invest more now, or are you saying to sell what you have and then rebalance it?
So if you came into this market with a portfolio that was appropriate for your risk profile, and now you're sitting on a portfolio that is more lopsided, right? Because if stocks fell and bonds rose, well, now you have an overweight to bonds. So it could make sense just to bring the weight back in favor of stocks. And if you actually have the ability to take risk and to wait out this recession, then maybe that just means going a little bit heavier into stocks and rebalancing back into bonds later. As far as to like what asset classes and specifically what stocks, so it depends on your level of sophistication and it depends on the way that your advisor works with you. So I think most people are really well suited for a diversified portfolio that consists of different like passive ETFs and maybe some mutual funds. And the spectrum of what you could put in there really varies. If you own individual stocks, it's a little bit of a different story. So actually, with my clients, we do pick individual stocks, and we have a couple of different strategies that we manage. And we weren't only doing buying; we also did some selling. And one of the things that we looked at was in early March, our assumption was that we were going into a recession. So we wanted to avoid some of the stocks that were maybe more directly exposed to the recession, and some of the stocks that had bad balance sheets that we didn't think would do particularly well in a recession. So I think that's actually important. If you own individual stocks, you should know what you own, you should know why you own it, and you should size bets appropriately. I don't actually think it's a good idea just because airlines are down 80%, or one stock that has a really bad balance sheet is down 90%. I don't think it's necessarily an obvious time to buy that stock and bet that it recovers, because if the stock's down a lot, it's usually down a lot for a reason, and that reason is because it's higher risk. So if you're gonna buy beaten up stocks, make sure you size your bets appropriately. Make sure that you size them small if you're taking on more risk. And I think as a general point in this market, if you don't know how to read a balance sheet, I don't think you should be picking individual stocks. I think that you should stick with the diversified funds where it kind of balances out the risk and reward for you.
Absolutely, and I have to say I do not know how to read a balance sheet for corporations, so I'm going to stick to ETFs and mutual funds. What's your take on the recession? How long are we looking at? What's the effects on the market? Is this going to be a 6-month problem, a 3-year problem? What's the range that we're looking at?
Yeah, so the really interesting thing about recessions and the stock market is that while they're closely related, they're not exactly the same thing. So the stock market doesn't exactly track when the recession happens. And I mean, let's just go back to 2008, when the actual recession happened in 2008, but stocks actually kept falling until early 2009. And it wasn't really clear until we were looking back when the recession actually started and ended, because recessions are basically calculated on subsequent quarters of negative GDP, and that's like a backward-looking number. And the stock market's forward-looking, right? So, so if we're going to focus on the stock market, from statistically speaking, if you go back and look at the last 10 or so recessions since 1950, it can take anywhere between 6 months and 18 months for the stock market to find a bottom. And, here we are in 2020, everyone's talking about a recession, and we're really only like 6 weeks into this. Stocks really started selling off at the end of February, and we're just in April. So if we're going by the traditional benchmark of how to think about the stock market in relation to a recession, it's still pretty early. But the other interesting thing about what's going on right now, and really the interesting thing that always permeates the market, is that there really is no manual for it. There's no formula for it. So it's really obvious that this isn't like a normal recession. First of all, this is a public health crisis, and then the public health crisis, due to the response to it, has created a recession. What does that mean, and how does that change the trajectory of how deep or how long? It's really anyone's guess. The other thing that has actually kind of led to this recent recovery in stock market prices is just the fact that we have an unprecedented level of government support. So as Will was saying at the top, there's literally trillions of dollars being pumped into the market from the Federal Reserve and the Treasury, and that's a little bit different from how the historical model of how recessions work, but it still creates a lot of uncertainty because we don't exactly know how effective that stimulus is going to be, and we don't exactly have a clear picture for how effective in terms of translating a stimulus in the financial markets is going to be to translating into an actual economic relief in the real economy.
Right.
So that's a really complicated way of saying that we don't really know. And I think the best way to think about it, though, is if you look at past recessions, it usually takes about 3 years and as long as 5 years, so 3 to 5 years, to fully recover from the peak of right before the recession started to when the recovery is in full swing. So 3 to 5 years to get a recovery in the stock market. So that's kind of why I go back to that keeping that long-term time horizon, because while I don't know where equity prices are going to be in, call it 3 months, 6 months, I would be willing to bet, and I am betting with my own portfolio that 5 years out, 10 years out, we're going to see a pretty robust recovery, and that's going to be reflected in healthy stock market gains. So really the key is just to build a portfolio that doesn't keep you up at night, right? Build a portfolio that allows you to focus on your business so you don't have to think about the markets. And just know that as long as you have that long-term financial plan in place and you're executing against it, it really doesn't matter. As long as your business is healthy, it doesn't really matter where the markets are to some extent. At least it doesn't matter enough to occupy your mind and distract you away from the things that do matter.
Awesome. All right, so let's dive into this. Let's start going into some of the ideas that you shared with us. I know you have listed tax asset swaps. Do you want to go into that?
Yeah. So so this is kind of more into the tactics of what every investor can do. That I just consider these are just the obvious things, right? The first thing is to rebalance your portfolio, sell some of the things that have appreciated and have less upside, such as like bonds, and buy and rebalance into some asset classes that have more upside that you're getting at a discount. The second thing is tax loss harvesting. And what that basically means is if you're sitting on losses in investments that maybe you bought at the start of this year or late last year, you can sell those. You could sell those investments at a loss, and then you can take that loss and you could apply it against other gains that you have in your portfolio, and you could even apply some of those losses against your income from your salary up to, I think, $3,000 a year, and that I think is a really obvious thing. So, but there's a couple of things that you have to know about tax loss harvesting. The first is, let's say, let me just give a tangible example. Let's say you bought S&P 500 ETF January 1st of this year. So you're down 15% on that. And okay, you could sell it today. You could take your 15% loss and apply the loss towards a future gain, whether that is a gain later this year or a gain 1 to 2 years out. One of the cool things about the tax loss is that you could actually apply it out for, I think, 20 years. So it's actually a pretty valuable asset. But okay, if you sell the S&P 500 ETF today, you can't just buy it back tomorrow. There's something called a wash sale rule, where you actually have to wait 30 days before you can buy back the same thing that you sold, so that you can keep the so that you can keep the loss. And that's just because the IRS doesn't necessarily want to just incentivize a bunch of people to take losses to, that could actually accelerate the decline in an asset or the market. So the rule is you wait 30 days or buy it on the 31st day, buy it back. So that's one thing you could do.
I got a question. So
yeah,
let's say S&P 500, it's $100, right? And then it goes down to 85. So we have 15% loss, right? Then I wait 31 days and I buy it back at whatever. Let's say it goes back up to $95. So it's gone up, was it like 8%, 10%, something like that. Can I buy it anytime after 31 days, or is this like within 1 year? Like, what is the frame? Like, I understand I want to buy it back right away, especially if it's down. But what if I wait 3 months and then I buy it back?
Yeah. So as long as you wait the 30 days, you could buy it back any time. You could wait a year, because basically when you're buying after the 30 days, for the IRS tax purposes, it's basically considered like a fresh investment with a new tax basis, right? So after you wait 30 days, it's basically, you can forget about the old investment you had. You're starting with something new.
And then you're watching
but you raise really, what's that? Well,
no, go ahead. I'm sorry.
Okay. But you raised like a really good point, which is if you're selling something after it's come down a lot, maybe just holding the cash from the sale isn't ideal, because if it came down a lot, it might also come back. And what if you sold something one day and in a month or two, it's actually higher than where you sold it? Well, then it would have just made more sense to hold on to it, right? So that's actually more of, so what you could do to avoid that problem of holding cash and missing out on the recovery is you could do a swap. So basically, let's say you own the S&P 500, you sell that, you get your cash, but you want to remain invested. Maybe you take that cash and you put it into something that's similar to the S&P 500, but slightly different. So maybe you invest into the NASDAQ 100, or maybe you invested into like the Russell 3000, which those are basically different stock market indices that'll still give you exposure to some kind of recovery. So if you still want to be exposed to the market, but you want to take advantage of the tax loss, then I recommend doing a swap into something else. And there's a little bit of ambiguity in terms of the laws, and this is one of the things where if you buy something else that's too similar to the thing you sold, then the IRS would actually consider it to be not a, like it would be a wash sale. So some people would argue that you could sell the S&P 500 fund being managed by like Vanguard and then buy the one managed by Fidelity, and some people would argue that that's actually considered like two legitimate investment products and qualifies for the beneficial tax treatment. To be safe, I would probably say that you'd probably want to do something that's a little bit more different. So maybe not selling the S&P 500 fund and buying the S&P 500 fund, but maybe selling the S&P 500 fund and buying like the NASDAQ fund. And if you wanted to go back to the S&P 500 fund after a month, well, then you could just swap back into it. I think another tactic here is, not everyone was fully invested. So what do you do if you have like a bunch of cash that's sitting on the sidelines? How do you know the best time to put that to work? Because as I just showed you, like, although the market swung down, it swung back up. Who knows? Maybe tomorrow it'd be up another 2-3%. Maybe next week it'll be down 10%. How do you time this when you have a bunch of cash, where it seems like every week, every month, you might be plus or minus 10-20%? And my advice to people who are with that situation is to do what's called dollar cost averaging, and that just basically figure out like a plan. like a timeline of which you're comfortable getting an average price. And let's say over the next 10 weeks, you want to put 10% of your cash to work week by week. And if you do it over time, that'll get you an average price. So you're going to be less susceptible to the wild swings that we're probably going to continue to have. I think there's a couple of other interesting tactics. One of the things that if you're in retirement, there's a rule where you have to take a mandatory distribution from your retirement account every year. I believe the Treasury has actually waived that, so you can defer your distribution, and that might be a good idea if you don't want to be a forced seller of stocks at low prices. Maybe if you can afford to wait a year for higher prices to sell, that might be a good idea. But at the end of the day, this is really just all about sensible financial planning, sensible investing. You want to just build a really robust, diversified portfolio so that you could focus on your business and not focus on the market. And it just all comes down to planning it out, thinking through what is your liquidity situation, how much money do you need, what can you afford to put into the market? Because if you put money into the stock market today with the knowledge that we could actually go down another 20-30%, you want to put that money in the market today with the idea of not needing to sell it in the next 3 to 5 years.
Otherwise, you should, maybe it's not a good idea to invest right now. Usually, you're saying. Right.
Take less risk.
So let's talk about what not to do. Right. So what's some strategies of what not to do right now if you're an individual, a business owner? Maybe I have a little bit of money on the side, but I'm trying to keep the cash because I don't know. I don't know if I'm gonna have my job, or I don't know if I'm gonna be in business in 3 to 6 months.
Yeah. And this is gonna sound repetitive, but I think what it comes down to, what not to do, you kind of get a lot into the psychology and the behavioral aspects of this. And really, the key thing is just to try to avoid making emotional decisions, right? So if you're checking the market every morning and you're just seeing your portfolio go down every day, at a certain point, you might just want to end the pain and just sell, go into cash because you're just tired of losing money. So I guess design the way that you interact with your finances in a way that will help you avoid making emotional decisions. So actually one of those things is, maybe don't check your portfolio every day. Maybe check it once a quarter, right? Or I think it actually is really important to have a plan, just so that you know why you're invested the way that you're invested, and that that you have conservatively positioned yourself such that in a worst case scenario where the market continues to go down and the recession lasts longer, that you're never in a position where you're being a forced seller. I think the biggest thing the biggest mistake people make when it comes to these kinds of panics is there's panic selling, but there's also panic buying, right? So after a week like this week and last week, where the market goes up 10-20% within a couple of days, you might just feel like you have to just start buying, right? And then if next week it's down 20%, you might feel a panic to start selling. And it's that kind of that cycle. You get into that cycle where you're not thinking long term. You're just looking to the next. You're just looking to the next week, and that's just not healthy. So I think the important thing to understand about investing is that, and it's not gambling, right? There's a positive expectation of return here. So, you could look at all the data and you could logically know that, okay, on average, the stock market goes up like 6, 7, 8% per year over the long run. And that average takes into account that some years we go up 20%, some years we go down 50%. But on average, it'll keep going up. And why does it keep going up? Well, the global, basically the world's just becoming more prosperous over time. Populations are rising, people are becoming more productive. Average standard of living is improving. As long as the world continues to become a better place over time, you should probably expect financial assets to reflect that prosperity. So just having perspective, staying long-term focused, it'll help prevent you from that urge to just go like all cash. And what happens when you go all cash is you miss the recovery. So if you go all cash today and you put all your money in at the top, well, you've taken a 10-20% haircut, and who knows, maybe the market does keep going up the rest of this year. I think a lot of smart people would argue against that, but it's certainly possible. So there's actually a lot of risk in being out of the market, right? Because if you're out of the market, you're not participating in that wealth creation from having your assets passively invested. Your assets are actually becoming less valuable because money is less valuable every year due to inflation, right? And unless you have a really large nest egg, most people need to invest in order to fund the cost of retirement and to fund the cost of college for their children and fund the cost of you name it, right? So there's actually a lot of risk of not being in the market. At the same time, if you're going to play in the market, there's definitely things that you should avoid doing, right? So if you're not a professional, if you're not at a hedge fund, I would avoid that day-to-day speculation. Don't day trade. It's not something that I do. Maybe some computer algorithm can do it, but definitely something I would not recommend even professionals do. Avoid the urge to invest in like really speculative companies that look like they could go bankrupt, but if they don't go bankrupt, then you make like 5 times your money. Unless you really know what you're doing, just avoid speculating. Stick to investing. Stay away from gambling, right? Don't invest with leverage. If you have 100,000 in your account, don't invest. Don't take on margin debt so that you can have 200,000 to play with. Because if the market keeps going down, you're actually going to lose a lot more money than if you had stayed unlevered. And some people really like the market, even people who aren't professionals, and some people just want to be in the market. They want to be making trades. And I have clients like that who, maybe they're wise enough to know that for the bulk of their portfolio, they want it with a financial advisor who's doing things that are more conservative, but they still want, I guess, they get enjoyment out of making some trades, and maybe there's some entertainment benefit out of it. So, if you do want to do the speculative stuff, maybe set up a small play money account that's just a really small percentage of your net worth that you could play around with, but definitely don't do that with, your retirement nest egg. And I think the last thing I would tell people to definitely not do is don't hedge. Don't engage in short selling. Don't use options to hedge. Don't use options to go long. Stay away from options unless you know what you're doing. If you're not a professional, don't try to pretend that you're one, because if you're doing like a shorting strategy, let's say, you're basically trying to be a hedge fund, but if you're hedging the market and you mistime it because you're not really on top of things, or there's a lot of just what's called random walk. you could actually significantly hurt your performance. So I just recommend staying away from shiny objects, staying away from things that look like, they could really juice up your returns or protect you, but they're really complicated and fancy. I just stick to good old fashioned, conservative investing.
Awesome. This is very insightful. Thank you, Luis. So let's talk about what is the right asset allocation for entrepreneurs, right? So a lot of entrepreneurs, we have our funds in our company. We don't have a retirement fund, most of us. We are hopeful that we can sell our business down the line, and that will be our retirement cash out. So what's your thoughts on that?
Yeah. So entrepreneurs are a very special group of people, right?
Oh, thank you, Louis.
and I include myself in that group. For better or for worse, when you're an entrepreneur, especially an early stage entrepreneur, you're taking a lot of career risk, right? You don't have that steady paycheck. Your business is probably a little bit more risky than had you taken the really stable job at a Fortune 500 company, right? So the fact that your career is riskier actually directly should translate into the way that you structure your finances. And for most entrepreneurs, that actually means that you should be taking less risk with your investments. And it really comes down to liquidity needs. So liquidity needs really trump all financial planning decisions for entrepreneurs, because if you're not taking a paycheck, or if your business actually is negative cash flow and needs more investment, you just need to make sure that you have the liquidity in a safe place so that you have a long runway, right? So the way that I typically help entrepreneurs think through their financial planning decisions is I basically sit with them and I map out their liquidity needs over the next 1 to 3 years, 3 to 5 years, 5 to 10 years. And then we match the investment portfolio in an appropriate way for those liquidity needs. So if you need cash in the next 1 to 3 years, you can't invest in the stock market. It's too risky. It could go down 50%. You really want to have that short-term money in like a savings account, checking account, money market fund, something that is pretty much guaranteed to be there. When you start thinking about the money that maybe you don't need in the next 1 to 2 years, but maybe in the next 3 to 5 years, that actually is probably still too risky for the stock market, depending on your risk appetite. But at that point, maybe at like a medium term level of liquidity, it would probably make sense to be invested in maybe defensive stocks and bond funds. And then for everything else that you feel pretty confident that you don't need to see for 5 years, 10 years plus, that's where you could start to think about putting your growth stocks, your illiquid assets, your investments that you don't need, that you really just want to improve your return, but you don't want to be a forced seller of.
And the liquidity, when you're saying liquidity, what are we talking? 6 months, a year of income? That like what is a safe? How much do we need to put aside for short term?
Yeah, so liquidity needs is one of these things where it really varies on the individual circumstances. I mean, let's just start with someone like a salaried employee who has a safe job, right? I think it's actually really prudent for even someone who has a really safe job to have like an emergency savings account where you have 3 to 6 months at a minimum of cash stored up in a savings account or checking account, where if worse came to worse and you did have to go find a new job, at least you know that you could pay the mortgage for the next 6 months. Then maybe going out on the risk spectrum a little bit, let's say you're an entrepreneur with a business that is paying you a salary. It's on, maybe it's profitable. You know, you probably don't need to have. So I guess liquidity, what I define liquidity is literally your cash needs, right? So if your business is going to be a drain on your cash needs, you just really need to think about, how do I have enough cash to meet those liquidity demands over that time horizon? So if you're like a later stage entrepreneur, maybe, acknowledge the fact that your company is probably less stable than like IBM or Apple, but it's probably a lot more stable than, a seed stage VC type company. So a little part of that comes down to your personal appetite for risk, but part of it needs to come from just an understanding of, okay, it probably makes sense to err on the side of conservatism and have maybe a larger allocation to those less risky assets like bond funds and defensive stocks. And I think this economy that we're in right now actually illustrates that point really well, because a lot of small and medium-sized businesses that were on a really good trajectory 3 months ago may not make it, right? And really what it comes down to is access to capital. So, if you're a small private company, you just need to understand that, if a recession comes, you're just at greater risk of having to do something else for one reason or another. And you just need to accept that and adjust. Yep.
Awesome. Okay. So we're going to head over to Q&A in a bit. Is there anything else that you want to leave us with? Any tips or thoughts or anything like that?
I mean, I think that especially if you're an entrepreneur, you should just really make sure that you retain good counsel. So have good tax, legal, and financial advice, just so that you don't you create a structure from which that you could focus on your business, because you don't want to have to worry about optimizing your tax and legal and financial issues on your own. So having just retaining the right advisors help you create the right financial plan, set up the right legal structure, have these people working for you so that you can focus on the things that you're going to do the best and just really leverage your own capabilities.
And before that, before I switch over, what is a couple of, since we're entrepreneurs, right? The typical person has like 401k and it's set up by their company and it gets invested. What are some tools entrepreneurs can use to invest money or to set up investments?
Yeah. So as far as retirement accounts are a great vehicle for anyone, just because you get a really valuable tax benefit. And there's also a behavioral advantage, because typically speaking, if you put money in a retirement account, you're not going to be able to cash it out, at least not without taking a huge penalty for many years. So that structure actually helps people maintain good behavior. But I would say, when you're an entrepreneur, you could actually, there's a few different options. You don't just have to set up a 401k. And it really depends on how large your company is and what you can afford. But there are things like there's a SEP IRA, and that has its own benefits. There's a traditional IRA. You could set up a small company 401k. Each plan has its own pluses and minuses. So that's really something where you should really ask your tax advisor what they think makes the most sense.
Awesome. All right, fantastic. So thank you for all this insight. We're going to go to Q&A now. So we'll get some questions coming in. Michael's has a list of questions there. Hello, Michael.
Hey guys, let me see if we can move ourselves around here. Yeah. I'm trying to get it so that I'm not the center of attention here. Give me one. Let's just go back to this for right now. Okay. He's kind of covered here. Hang on. Let's do this.
Perfect.
There we go. Covered Jimmy. So we have a few questions here. I'm super interested in all this stuff too. Like stocks were my first love in business. I got interested in the, like sophomore year of high school and invested in stocks and stuff in college. Obviously, I'm way more risk. Like I love risk, and I like to take small bets that have high chance of doing really, really well and whatnot. And a lot of the stuff that I do, it's not like a long-term conservative approach to many things. But I love your advice that you shared. I think to add on to some things too, that's really been helpful for our company and just me and myself. And something that I've been really doing much more as I've gotten older is there's a lot of even just basic bank accounts, savings accounts that you can put your money into that can get you literally 10, 25x a traditional bank savings account. And there's a lot of these that are coming out now as well. Ally Bank, you have Marcus from Goldman Sachs, you have all sorts of different stuff. Robinhood is even doing 1.25%. We have a bank account with Bank of America. If we would have left our money that we raised in there, we would have gotten 0.01% interest back. We moved it over to Merrill Lynch, part of the same company. They're giving us what used to be like 1.9. Now it's more closer to 1, but we're still able to get so much more interest back on our money just by putting it in a strategic savings account. And I do this personally as well with some of my money, and I have it in different savings account. It's not a lot, but as you build up over time, it goes a long way. I don't know if you have any thoughts on that. The other thing too, I'd like to mention, it's one of the questions that we have here about dividends as well, and how important dividend stocks are. But I'd love to hear your answer on, it's just really a personal question, but I'd love to hear your thoughts on just like easy, savings accounts, and how important those are. That it's just such a simple way for people to make money that they would otherwise not be making.
Yeah, absolutely. So it is an interesting point, and an important one. Checking accounts give you nothing, and a high yield savings account is going to give you something. That used to be 2%. Now it's probably getting close. Interest rates have been cut, but that 1%, adds up, right? Over many years, it adds up, and it compounds on itself. One of the things actually that I would be careful about is in the last couple of years, there's been some like startup companies like Robinhood and Social Finance, where they come out and say, oh, here's a new savings account. We're going to give you 3%, right? And then if you look into the details, it's actually not a savings account. It's actually a brokerage account, and it's not FDIC insured, right?
Right.
So
for sure.
Make sure you understand the type of account, right? And just understand that if you think it's safe, make sure it's FDIC insured if it's a savings account. The other interesting thing too, and this kind of gets into like the value of like bond funds, is if you actually do have a brokerage account, you might be able to get like an extra 1 or 2 points of interest if you invest in like the bond index or corporate bonds, right? And so that's where it kind of gets into the point of, don't just think about conservative investing as one thing, right? So obviously a savings account's really conservative. That's a good place to park money. It should be FDIC insured. But if you already have, call it a year of liquidity in your savings account, and maybe there's also the problem of some people, they just don't want to take the risk of the stock market. It's also worth looking into other conservative options, right? Maybe that's dividend stocks. Maybe that is a bond fund. One interesting thing that a lot of people don't actually know about is if you have a brokerage account, check and see if you've enabled security lending. So that just basically means that you can lend your investments to people who want to short sell, and they pay you interest. And for my clients, everyone is has like feature like this enabled, and it gets us actually an extra 0.5% to 1% a year, right?
Wow.
And that's actually, you're not actually taking any risk. Other people are paying you for the right to borrow your shares.
Yeah.
So that's actually something worth looking into for people who have brokerage accounts.
That's
On
pretty
dividend
cool.
stocks, dividend stocks are great, right? If you kind of look into, so one of the things I mentioned was that I kind of bucket assets into 3 categories: short term, medium term, and long term. And the way that I think about it is the money that you have in each bucket of assets is determined by your ability to take risk and your willingness to take risk. So that goes back to your liquidity needs. And then depending on what your time horizon is for your different assets, that actually gives you the permission and the ability to invest in certain asset classes. So typically speaking, a company that pays a dividend can afford to pay the dividend because it's either profitable or somewhat mature, and it's giving investors a return on their money. And it's supposed to be something that's consistent. So, as a general rule of thumb, companies that pay a dividend are typically more defensive. They're typically more stable. They're typically more mature. So, that's something that could be in that like medium term risk bucket. It's definitely going to be less risky than a recent IPO that's still unprofitable, but it's probably going to be more risky than like an investment grade bond fund or a municipal bond fund. But the thing about dividends is you have to be careful, right? Because dividend yields can change. And this really all goes back to the idea of, if you don't really understand what's going on, and if you can't pick up a company's annual report and understand the balance sheet and the financial statement, then focus on investing in funds. So there's plenty of dividend funds that can give you a diverse portfolio of dividend stocks, but stay away from investing in individual stocks if you really don't understand all the nuances there.
Yeah, I totally agree with that. I love that. Yeah, there's some ETFs of, you can just get into an ETF of high yield dividend stocks too. Those are interesting. But then it goes into the question from Rhonda that we have here. Do you think companies are going to be cutting dividends this year and next year, and as this whole thing goes on? I mean, I've already seen some that are cutting it, or even just wiping it out or putting it on pause. So what are you seeing in that regards with dividends?
Yeah. I mean, we've already seen it start. A lot of companies have already started suspending their dividends, suspending their buyback programs. We're really in the early stages of seeing the playbook from 2008, 2009 come back out. And one of the things I do in my day-to-day is I have conversations with executives at some of the companies that we invest in, and I ask them, what is your assessment of the business landscape? What are you guys doing to prepare? And the one thing that's been consistent from my conversations over the past couple of weeks has been people mentioning, that they're bringing out their 2008, 2009 playbook. And what that playbook is companies are trying to figure out where they can cut costs. So maybe they cut advertising spend. Maybe they have, I mean, right now, obviously no companies are doing corporate events, but when we come back into the back half of the year, maybe the Christmas party is not going to be as nice as it was last year. There's a lot of social pressure right now at the companies to not lay people off because, obviously the health crisis is front and center, and we really don't know what the economy is going to look at when we come out of this. But based on what my read is, we're probably going to see a good amount of layoffs, and actually we have started to see some, although I think companies are holding back until they know how much they have to cut. And as it relates specifically to dividends, part of that 2008, 2009 playbook is companies want to preserve their balance sheet, right? If a company sees its cash flow go down 50% and it was using 90% of its cash flow to pay its dividend, they're going to be really reluctant to keep paying that dividend if it means that their balance sheet's going to be in a worse case. And what I mean by that is they don't want to have to borrow a bunch of money and risk potentially going bankrupt.
Yeah, I think that makes a lot of sense. I think, and I think a lot of what's happening right now too is, like you said, people are kind of waiting to see what happens over these next couple weeks, and like really this month. I think April is such a critical month for all of this right now, because everyone's like, is things calming down? Is it peaking? Are we going to get back to normal in April, or is April still going to be locked down and then maybe get back in May? And who knows? So
yeah, one of the interesting things about dividend companies is that they tend to be in a lot of the industries that are actually really badly affected right now. So a lot of dividend paying companies happen to be in like the natural resources space. So energy, stocks, MLPs, real estate companies tend to pay a lot of dividends. And right now, guess what? A lot of people are not paying their rent, right? So, a lot of these companies that are over indexed to like these dividend ETFs are cutting their dividend already. Yeah.
Yep. I've seen that. We have another question here from Rhonda as well. Can securities lending, what you mentioned earlier, be done from an IRA brokerage account, or like a Roth IRA brokerage account, or just a taxable brokerage account, like a normal individual non-retirement account?
Yeah, it can be done in any account. It depends on your broker. So this is actually a trick that a lot of brokerage companies have been using lately. Is you may have heard that trading commissions have gone to zero, right? Well, the trick is that some brokers will reduce trading commissions, but then they'll keep the security lending revenue for themselves, or they won't. They'll take all the interest from your cash balance and keep it. So the short answer is that securities lending can be done in most types of accounts, but it just depends on your broker. So that's just really a question of, do you use Fidelity or do you use Schwab? Which one's going to pay you the highest interest on your idle cash balance? Which one's going to give you some revenue from securities lending?
Real quick, which one do you recommend people use? I mean, E-Trade, Robinhood, Fidelity, Schwab. What's your pick?
Yeah, I mean, I don't think I want to recommend a specific broker. We at my firm, we use a couple of different ones, but I just recommend that people just look into that issue. Securities lending, is it something that they have in their account? Are they getting a good rate?
Gotcha. Okay. We have another question here from YouTube. I'm going to pull it up on the screen here. What's the average percent of your revenue should you be saving in general?
As from like a business or from an individual?
Maybe from both. I mean, I think the general thumbs around 10% typically is what, most people recommend. Do you agree with that? Should it be higher, lower? What are your thoughts?
So I guess I think about it really, I don't think about it in percentage terms. I think about it in dollar terms. And, I'd say like for an emergency savings account, 3 to 6 months of your burn. And what's your burn? That's your budget, right? So on average, what do you spend every month? Multiply that by 6. And I think that's a good goal to have in terms of what you should be keeping in terms of cash on hand for your individual balance sheet. And the rationale there is because, if worse comes to worse and you do have to go find a new job, it's probably going to take 3 to 6 months at a minimum to find a new job. And it could take longer, especially in a bad economy. And, unemployment benefits help. And, maybe there's things that you could do. But 3 to 6 months of your burn, I think, is a good starting point. And then, you mentioned, so we could also think about this in terms of a business context, which is how much liquidity should a business have? And I think the answer is very different post COVID-19 compared to pre COVID-19, because, liquidity has never been more important than it is today. So I think that companies should now really start to think about, in the future, should a company have an emergency savings fund or a source of liquidity? And that liquidity could be in the form of a bank line of credit that you just leave undrawn. And it's probably a good idea to start thinking about rainy day sources of liquidity for businesses in the future.
Okay, great. It looks like there's a couple of previous questions that we had for Will, that he's with a client right now, but he was able to text me the answers to that for us. And if anyone else has any questions for Luis, now is the time to ask them, because we're getting ready to wrap up here. So the questions on the tax stuff. So to clarify, is the $1,200 just tax credit for 2020? The 1,200 checks that everyone's getting sent out, is that just tax credit for 2020? The answer is yes. So it's really only if you've really filed your 2019 taxes are the people who are getting these checks, and it's really just a tax credit, not necessarily just a flat $1,200 check. Can a self-employed person with no employees apply for both the EIDL loan and unemployment? The answer is yes to that as well. If you guys have any questions for Will, just email him at will@wintercpas. We'll be sending a follow-up email with all the stuff too, guys. So if you have questions for Will or Luis or myself or Jimmy or really any of us, feel free to reach out. I've been having to change my background because it was raining and then I was losing signal. So I've been all over the place. It's just the stay-at-home life. But thank you all for watching. Luis, if you want to say any final thoughts or any other final piece of advice, now's the time. It doesn't look like we have any more questions coming in. It looks like you got to everything. So we'll leave it there.
No, thank you for having me. And yeah, if anyone has any questions, it looks like my email is down there. Feel free to reach out. And other than that, I just hope everyone stays safe and stays healthy. And yeah, as we get through this.
Luis, thank you so much for your time. Your insight's been great. We really appreciate it. And so stay safe, stay healthy. Thank you so much.
Yeah, thank you, Luis. Thanks, Jimmy. Appreciate it, guys. Thank you, everyone watching. Reach out to us if you have any questions. And we're going to be doing this every Thursday for the time being, going over updates on all this stuff and bringing in new people. next week we have a mental health therapist. She's a founder, author. So we're going to go through some best practices on dealing with some of the stress and anxiety and even depression going on right now, with people's businesses and just everything. So, we'll get into that next week. Really appreciate it. We'll put follow-ups to all the Luis's stuff in the email too. So thank you everyone for joining, and stay up to date with all of our events coming up too. But appreciate it, guys. Thank you.
Thank you.
Thanks. Bye.